Strategy Talks. Today is Monday, July 29th, and I am joined once again by our Chief Investment Officer, Nick Ryder. Welcome, Nick.
Thank you, Vinny.
Now, today, Nick and I will be discussing recent political developments offshore and some of the economic considerations of these, the pause for consideration on Mag 7, and a big week ahead for central banks. Nick, it's been several weeks since we last sat down and recorded the pod, and quite a bit happening in the political sphere over that time. We had a new Labour government, led by Keir Starmer in the UK, and a significant twist in the US presidential election with a replacement of Democratic candidate. Seems Kamala Harris has very quickly locked down that nomination. And you wrote in our newsletter last Friday about Trump's politics and his probably growing momentum behind his campaign, and particularly some of the protectionism that we might see out of Trump 2.0. Do you want to maybe open up and talk a little bit about that?
Yeah, I think, it's one of the things that markets are starting to focus on is, what a second Trump presidency might look like. What are the policies that he sort of flagged he would introduce. And I think, one of the key ones is further trade protectionism. It's really this isolationist policy that Trump and Make America Great Again is really embracing. And so one of the things that he's talked about is 10% tariffs on all imports,
right,
to the US, and 60% tariffs on imports from China. Now of course, we had the trade wars back in 2018, 2019, and they were quite disruptive for markets. Markets didn't really like that. There was a lot of uncertainty. It was quite a fluid situation with tit-for-tat responses from China as well. So I think
But what we're looking at here is potentially quite a level up in terms of the scale and the aggression of the tariffs.
Well, absolutely. The first ones, from memory, were on things like aluminium and a few sort of key industries, particularly Rust Belt type industries, and that affected some countries. I think Australia was able to escape that, but a 10% tariff on all imports would really impact Europe in particular, but also Australia. And I've heard, secondhand, Jim Chalmers, for example, is quite worried about what that might mean for the Australian economy. Not that we're necessarily a huge exporter to the US, but it's still impactful. So I think that's something definitely to be aware of.
And it would be big impact on the US economy as well.
Well, that's right.
Inflationary import.
Well, there's obviously that one-off inflationary impact, which you would think the central bank, the Fed, would look through a one-off, a boost from tariffs. But there could be ongoing inflation pressures, so there'd definitely be an element of that. But there's also a hit to GDP. Tariffs. Free trade is usually a good thing. It boosts, consumer purchasing power, and a tariff on all imports would actually impact those on the lowest incomes more heavily. So it actually
will affect a lot of staple goods.
A lot of staple goods. The US is running a massive trade deficit with everywhere, including China. So it would have a large impact. Probably a bigger impact on Europe, given the nature of their economy, particularly auto manufacturing and things like that. So I think it's definitely something to watch out for. Not necessarily the tariffs per se, obviously that would have an impact, but also just the impact on investment and uncertainty and markets. Not good for confidence.
Yeah.
And I think there's the second leg, which is obviously immigration, which has been a big problem. But immigration, to some extent, has probably kept wages lower than they would have been. So there's also potentially an inflationary impact from lower legal and illegal immigration into the US that would have an impact as well, and growth.
Yeah, there's no doubt a huge portion of the US economic growth story has been built on that cheaper labour. As you said, some of it illegal as well as legal coming into the country. Politics in general, regardless of candidates, it's not something that you typically you find is going to change how you position portfolios.
No, it's very, very difficult. I do get questions from clients about this, what it might mean. And I think, if you look back on the first Trump presidency, markets got a real boost because he cut taxes.
Well, it was quite spectacular. Our market was open and trading and panicked. Then closed that day, I can't remember, down a couple of percent, maybe more. and then the US market opened up to rapture of excitement.
Well, that's right. I mean, cutting corporate tax from 35% to 21 was like a massive one-off boost to earnings. So that gave the stock market, good gains initially, and then kind of later on in the presidency, 2018, 2019, we had all the trade wars. So it's very difficult to time it and what it might mean for markets, because often there's things working in kind of opposite directions to each other, and it's just which forces kind of dominate. So it's quite difficult to necessarily get an interpretation of what it might mean for equity markets in particular.
Well, equity markets generally probably don't love uncertainty, so often just getting to the other side of the election and getting sort of policy platform certainty tends to be a positive for markets.
Yeah, I think in general, and I might have mentioned this on previous podcasts, is markets kind of a little bit volatile leading up to the election, and then when they know who the new candidate is, kind of post-election, they settle down a little bit, and often get a little bit of a boost just from that removal of uncertainty that you get when you know who's going to be in power for the next 4 years.
Yeah, what that policy platform looks like. We've spoken regularly on the podcast this year about the Magnificent Seven and the sort of unchecked rise of the Magnificent Seven. Well, interesting, the last few weeks we started to see some, question marks and a bit of a rotation away from them.
Yeah, I think, some research I read from Goldman Sachs, which was quite thoughtful about, what all of this means. Certainly the hyperscalers, your Googles, Microsofts, Amazons, etc., are spending vast amounts of money on training these large language models, these foundation models. It's unclear what the revenue model is.
It's not a very direct line between automatic internal.
At the moment, it's a bit of a toy. It's what they call a solution looking for a problem. What are the real use cases and how can you monetize it? How can you get money out of offering this? I mean, certainly there's money if you're a corporate user of ChatGPT, you've got to pay for it, but
not the mega money that justifies the current level of investment.
Yeah, so I mean, these companies are spending billions. You just got to look at Nvidia's revenues. It's gone from a run rate of about 40 billion a year to 180 billion. That's all chips being used to train these large language models. So they're definitely making hay while the sun shines, but it's very unclear, with all this money being spent, what is the return that's going to come back? In some cases, these are commodity products. Llama 3 from Meta or Facebook is basically free, open source. They'll give it to anyone. They've spent a lot of money developing it, and so it's become commoditized to some extent. And so, you get the sense that some of these companies are doing it for defensive reasons, not necessarily to try and make money out of it, incremental revenue.
Worried about the fear of missing out if they're not at the table and having this.
So I think that research has given the market some pause. We've had a couple of the Mag 7 report earnings, so Tesla quite disappointing. They've got no new models. Their margins have been contracted. Their development of full auto driving cars keeps getting pushed back. So they didn't really have a particularly good result. And Google's result was good from a revenue perspective. Maybe the YouTube revenues weren't quite as good as hoped. But their spending.
Cloud computing is still very strong.
Cloud computing is good, and it's been helped by AI demand. But does it justify the increase in CapEx? So they spent $13.5 billion on CapEx in Q2. That was more than what people were thinking. They spent, I think, 33 the whole of last year. So their run rate of capital expenditure is a lot higher. So it goes to that theme of spending lots of money, not necessarily getting an immediate return.
And the market's now just taking a bit of pause, and we're seeing the rotation actually go back into areas like smaller companies which have been, I won't say perennially underloved, but underloved for a long period of time.
Yeah, so in the US, the Russell 2000, which is the 2,000 smallest companies in the US market, had a cracker of a week in the week ending the 18th of July, which I wrote about in SB News, and that's really partly due to, rotation out of the Mag 7, looking for the next home, and that's an area that's been unloved. so that helped. Small companies would probably benefit disproportionately from a trade war, the isolationism, because they're more domestically focused, so that was the second thing. The third thing is there's more confidence that the Fed will be cutting rates this year, and a lot of those companies have floating rate debt, as opposed to bigger companies that issue fixed rate bonds to fund themselves, so they're more sensitive to falling rates. And the final thing is US GDP growth is actually pretty good. So we got the advanced reading of second quarter GDP in the US last week, came in at 2.8% annualised, well above expectations of 2%.
Very, very solid.
Yeah, so US economy doing well, and so smaller companies are more economically sensitive to the growth picture. So I think those are the four things that sort of driven some of that rotation. So even last week, which was a weak week for equity markets, so the Nasdaq was down 3%, Russell 2000 was up 3%. Yeah. So we'll just watch this space.
Yeah, that's perhaps just an early stage of some normalisation of the market as well.
But I would add, it's only in the US, not in Australia. There's still small caps in Australia still struggling.
Very different small cap index here as well.
And
miners.
And Europe really hasn't seen much of a rebound either.
And again, probably not. Well, I guess here the economic picture is still pretty tepid, and you've talked many times about sort of the per capita recession in Europe, not significantly better. The US is probably the exception in terms of their economic strength to probably justify that confidence in the broader economy and in the broader market. Let's you touched on there at some of the US economic figures. We've got a Fed meeting coming up. Their economy is quite strong. They've had some progress on inflation. Where do you sit now in terms of your thinking on the trend of interest rates?
Yeah, well, so we'll get more information. Obviously, the Fed, I don't think the Fed will cut rates this week. So they're meeting on Wednesday night our time. But we'll get more colour in the post-meeting statement of what they're thinking. But if you look at all the comments from Fed officials over the past month, they're all sort of, and they're not going to give away too much, but basically sort of reading between the lines, they're more encouraged by what's happened with inflation. So we had those bad inflation prints at the start of the year. May, June were good. So if we got another one for July, that's 3 months in a row. That would give them more confidence that inflation was sustainably on the path to 2%. So on a 3-month annualised basis, inflation's kind of got around 2% at the moment.
Getting into that
so
target
it's pretty much kind of at the Fed target. And the other thing that they're worried about, so the Fed officials, you might recall that every quarter they put out their summary of economic projections. So they had core PCE inflation of 2.8% projected for this year, so it's already below that now.
Yeah.
And they had unemployment of 4%, and unemployment's already above that now. So that would give them more confidence relative to their forecasts
to justify making that first move.
Absolutely. So I think the market's locked on to September. We've got 28 basis points, so a full cut priced at the September meeting, and that's where my money is at the moment.
Okay, that obviously pre-election, that one.
Yeah.
But still a broadly expectation, even when they do start to cut, it's going to be a slow, gradual process there. We're not slashing rates back.
Yeah, I think it would be unlikely we'd see back-to-back cuts. It's probably like one cut a quarter type thing, So there's certainly no hurry to bring them back down.
Keep an eye on the data, unless something significantly changes in that economic picture, which is looking pretty resilient at present.
Absolutely, and then if the Trump 2.0 tariffs came in quickly next year, maybe that would change the picture a little bit.
We would have to really wait and see what actual impact that has on the economy, because that is a big disruption. Closer to home, all eyes, all anticipation very much on this quarterly inflation data. We've really been building up to this one to give us, I guess, any sort of hope or confidence that inflation is beginning to be brought more under control.
Yeah, and based on the forecasts, it's basically going to be the same number as last quarter. So we're basically seeing inflation track sideways. So the market's got a 1% quarterly forecast, or 4% annualised, and that's the same as what it was last quarter. The RBA has a 0.8 forecast. So the market's above where the RBA is.
Right.
So if we see maybe a 1.1, 1.2, possibly another rate rise, although I think it's unlikely, but the market's got like a 20% chance of another rate rise in August.
Right. So the market's currently, I guess, we'll wait and see this data, but pricing in maybe a modest chance of one more rate hike.
Yeah.
And then when are they thinking that cuts could be occurring? Where's the market currently pricing in the first cut?
May of next
May
year.
of next year. It's really
Pushed out. Yes.
Worth remembering that Australia started their rate increases later than other parts of the world, and we did not get as high. We're a full percent below, for example, where the US is at in terms of rates.
That's right, and there's also some research I saw that I'm not sure how much of a bearing this has had on the economy, but we did cut rates more, and we did kind of pump in more fiscal monetary stimulus into the economy relative to other countries around COVID. So we provided more stimulus, and then we tightened less in the post-COVID period. So that's why some economists like UBS and Deutsche Bank are arguing that another rate hike's needed.
Still needed. Yeah, and we very much have this sort of two-tier consumer, if you will. That I guess it depends if you are a saver or a borrower.
Yeah.
If you are a saver, then you're doing quite well out of these higher rates. And we know there's plenty of stress, in pockets of stress in the economy, I think, in the more indebted households.
Yeah, well, that's right. Central bank has only one lever to pull, and it's a blunt instrument in terms of who it affects. And we are seeing consumer spending, discretionary consumer spending, quite soft. So, as we head into reporting season for Australian companies, particularly consumer stocks, they've already really reset their expectations quite low. So it'll be interesting to see how those companies report and what they say about the performance of sort of the retail sector post 1 July kind of tax cuts as well, whether there's been any uplift.
Mm-hmm. Yeah, because there's been a fair degree of pessimism there, which again would probably give the RBA some scope to just hold on a little further rather than quickly hitting that big increase.
Yeah.
Anything else catching your attention at the minute?
Just I think so we're going to got Microsoft, Amazon, and Apple all reporting this week. We've got the Fed meeting as we discussed. We've got the Bank of Japan. Now there's a good chance that they might lift rates again. Inflation's sort of sustainably above 2% there, and the yen's been exceptionally weak. So I think there's a sort of 50-50 chance that they'll raise rates, and the Bank of England as well.
Right.
Cut rates, there's a sort of 50-50 chance they're meeting later this week as well. So there's a few things, and then another US employment report. We've seen US employment sort of gradually soften over the past 6 months, so that'll be eagerly watched on Friday night.
Yeah, another factor in the mix there for the Fed, considering their moves. Excellent. Oh, it's good to have you back, Nick. Good to be back recording once more. Thank you to you, and thank you to all our listeners.